The Dow Jones Industrial Average plummeted 900 points to a 3.5-month low. Unemployment rose to 4.4%, while WTI crude oil surged past $90 per barrel. Despite resilient AI infrastructure demand, the U.S. market succumbed to stagflation fears as surging energy costs collided with a surprise contraction in the labor market. Energy supply constraints. The conflict with Iran led to a 7-day blockade of the Strait of Hormuz. This disruption affects 20% of global oil shipments and halted Qatari LNG exports. President Trump's pledge to escort tankers provided only temporary relief to energy markets. National gasoline prices rose to $3.32 per gallon as supply risks intensified. Investors shifted capital toward energy dividends like Oxy and COP for protection. Labor market shakes. The U.S. economy lost 92,000 jobs in February, missing forecasts for a 55,000 gain. This labor downturn increased credit risks for regional banks and private credit providers. Western Alliance wrote off a $126.4 million loan following a counterparty default. Financial stocks retreated as investors feared rising defaults and lower borrowing activity. These figures suggest that high costs are finally impacting employer hiring capacity. AI sector decouple. Marvell Technology forecast $15 billion in 2028 revenue due to custom chip demand. Broadcom guided for $100 billion in AI chip sales as infrastructure spending remains robust. The trade desk surged following reports of a potential advertising deal with OpenAI. These specific catalysts allowed semiconductor leaders to decouple from general market volatility. However, rising energy costs threaten the intensive processes required for chip manufacturing. Monetary policy. Rising energy prices made the Federal Reserve less likely to implement immediate rate cuts. Bond traders sold debt as average hourly earnings rose 0.4% to keep inflation sticky. Markets now price a high probability that the Fed will pause in March. The 30-year mortgage rates hit 6% as yields responded to the dual threat of inflation and war. This environment has pushed the Buffett indicator to a record 220% valuation. The transition from a growth-focused market to a stagflationary regime forces a defensive rotation into energy and dividends. Next week's direction depends on the March 11th inflation reading and any signals of Middle East de-escalation. Key variables include the CELSMA trade review and the Federal Reserve's response to labor contraction. Persistent fuel inflation makes the next rate decision difficult as stagflation risks intensify.